CEOs earning $5 million a year in Switzerland, Singapore, and the UAE are mathematically poorer than executives pulling $3 million in low-tax jurisdictions. That's not hyperbole, that's what the numbers show. Welcome to Data Fortune Research, where we break down wealth using actual data. IRS Statistics of Income, Bureau of Labor Statistics occupational reports, and Federal Reserve consumer finance surveys. Today, we're exposing the CEO pay paradox. Why more money in the world's richest countries means less money in the bank. Let's start with the raw salary data. According to IRS Statistics of Income analysis from 2023-2024, the top 1% of U.S. earners, roughly 35 million individuals earning above $578,000 annually, represents a baseline for high-income comparison. But when we look globally, the picture shifts dramatically. Research from the OECD tax database and BLS occupational statistics indicates that median CEO compensation in Switzerland averages $4.8 to $5.2 million annually, compared to the U.S. median CEO pay of approximately $3.6 to $4.1 million. On the surface, Swiss CEOs win. They're earning 25-30% more in gross salary, but here's where the paradox begins. The effective tax rate is where wealth evaporates. Data shows that top 1% earners in Switzerland face marginal income tax rates of 40-42% at the cantonal and federal level, plus mandatory social security contributions totaling 7-8%. That's not 40% on the first dollar, it's progressive. But for a CEO earning $5 million, the effective tax burden climbs to approximately 38-40% of total income before any wealth taxes, property levies, or cantonal surcharges. In the United States, comparable top earners face federal marginal rates of 37% plus state taxes, which vary widely. In Florida or Texas, top earners pay roughly 37% federal plus 0-5% state, bringing effective rates to 37-42%. But here's the critical difference. Once you account for deductions, capital gains treatment, and charitable giving structures, U.S. top earners often reduce effective rates to 32-35%. Swiss counterparts. The research indicates minimal deduction flexibility for employment income, leaving effective rates locked at 38-40%. Then comes cost of living, the silent wealth killer. Numbeo cost of living data from 2024 shows that Zurich, Switzerland ranks as the third most expensive city globally, with housing costs consuming 35-50% of high-income household budgets. A four-bedroom home in central Zurich averages $3.2 to $4.5 million for purchase, or $12,000 $18,000 monthly for rental. Compare this to Dallas, Texas, where a comparable property rents for $4,000 $6,500 monthly, or Scottsdale, Arizona at $5,500 $8,000. For Swiss CEO earning $5 million gross, we can model the cash flow. $5 million gross minus 39% taxes equals $3.05 million net. Housing consumes $180,000 $216,000 annually, leaving $283-287 million for all other expenses. Insurance, education, transportation, and household staff easily consume another $400,000 $600,000 annually in Zurich, leaving roughly $223-247 million in actual discretionary wealth. Now model the same CEO in Dallas earning $3 million gross. With effective taxes at 35% federal plus state deductions, net income reaches $195 million. Housing costs $60,000 $78,000 annually, and living expenses run $250,000 $350,000, leaving $152-164 million in discretionary wealth. The Swiss CEO earns 66% more, yet retains only 35-45% more actual usable wealth. The salary premium evaporates. Singapore presents an even sharper paradox. Research from Singapore's Ministry of Manpower indicates median CEO compensation ranges $4 to $4.8 million annually, comparable to Switzerland. Singapore's headline corporate and personal income tax rates appear lower, 22% for corporations, 22% top personal rate. But CEO compensation analysis shows the effective burden climbs when accounting for mandatory central provident fund contributions of 17% employer and employee combined, and property taxes. The actual effective rate approaches 30-33%, lower than Switzerland. But Singapore's cost of living tells a different story. Data from Numbeo shows Singapore housing costs average 28-40% of high-income household budgets, with prime properties in central business districts renting for $15,000 $25,000 monthly. International school fees for executive families run $25,000 $40,000 per child annually, and relocation costs for talent-dependent executives add another 15-20% to annual budgets. A CEO earning $4 $5 million net after 30% effective tax retains $3.15 million, but living expenses consume $800,000 $2 million annually, leaving $1.95-$35 million in discretionary wealth. The United Arab Emirates, Dubai, and Abu Dhabi initially appear to solve this puzzle entirely. Zero personal income tax on employment income. A CEO earning $5 million retains the full $5 million. Here's where it gets complicated. Research from the Federal Reserve Survey of Consumer Finances and International Wealth Studies shows that ultra-high net worth individuals in the UAE face hidden costs that offset the tax advantage. Private aviation, security, healthcare for expat families, and wealth preservation vehicles consume 20-30% of high income. Additionally, employment contracts in the UAE often include non-monetary benefits, housing provided by employer, transport stipends, education allowances, that reduce take-home cash requirements but are taxable in home countries if the individual maintains citizenship elsewhere. For U.S. citizens or EU nationals working in Dubai, compliance and dual tax jurisdiction planning costs 8-15% of income annually. Let's look at the data on wealth retention more directly. Analysis of top 1% net worth thresholds shows that in 2024, households in the top 1% possess approximately $11.6 million in net worth. But research from the Federal Reserve indicates that wealth accumulation rates for high-income earners differ by jurisdiction. U.S. top earners accumulate wealth at roughly 8-12% annually after all taxes and living expenses. Swiss CEOs, despite higher salaries, accumulate at 6-9% due to tax and cost of living drag. This compounds dramatically. Over a 20-year career, a U.S. executive earning $4 million and accumulating at 10% annually builds wealth to approximately $52 million before market fluctuations. A Swiss peer earning $5 million but accumulating at 7.5% reaches approximately $48 million. The $5 million salary premium produces a $4 million wealth deficit. The research also reveals structural reasons for the paradox. Data from BLS occupational employment statistics and IRS SOI tax records shows that in high-tax jurisdictions, income compression occurs at the top. When marginal tax rates exceed 40%, the incentive to earn incremental income diminishes. This causes CEO salary negotiations to stagnate in Switzerland and high-tax EU countries, whereas U.S. corporations continue pushing compensation upward due to lower effective tax burden. In 2024, the top 1% of U.S. earners, roughly 135,000 individuals earning above $2.5 million, comprise approximately 18-20% of all U.S. income. In Switzerland, top 1% earners represent only 11-13% of national income, suggesting either lower top-end pay or higher wage compression. One final data point ties everything together. Research from the OECD and various tax authorities shows that ultra-high net worth individuals, those with $30+ million net worth, employ sophisticated tax and cost management structures that lower effective rates to 20-28% globally. But this optimization is expensive, legal, accounting, and estate planning costs run $150,000 annually, accessible only to those already at extreme wealth levels. For the $3-5 million annual earner, the CEO cohort we're examining, these tools are partially effective but still leave them bearing 32-40% effective burdens in high-tax countries. The paradox resolves when we stop looking at gross salary and start examining net worth velocity, how fast you actually build wealth after all claims on income. The data clearly shows that a $3 million earner in a low-tax, moderate cost of living jurisdiction accumulates wealth faster than a $5 million earner in a high-tax, high-cost jurisdiction. This explains why so many wealthy executives relocate from Switzerland and Singapore to Dubai.